Thanks for listening to The Derivative. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.
Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world.
This was some Chris Cole commentary, but I think it's, echoed by the other participants on both panels. Just the magnitude of option flows currently versus pick a number, 5 years ago, 10 years ago.
Yeah.
And both, institutional and retail. Obviously, the Robinhood stuff has gotten a lot of publicity this year, but the thing that brought home to me is options are inherently a source of leverage, and that's good when it works.
Good,
right? But it's essentially increasing leverage in the system, and that cuts both ways, right? And so we see these reactions in the market. These V-shaped recoveries and these precipitous drops. We're used to people saying you take the escalator up and the elevator down. Well, we're now seeing elevators going in both directions.
Yeah.
And I think a decent chunk of that is the implicit leverage that we've added to the system over time.
Hello, welcome back, everybody. We're doing something a little different today and are breaking down some of the highlights and best things we heard at the recent virtual EQ Derivatives conference. Where vol trading heavyweights like Bhansali, Chris Cole, Benn Eifert, and Jim Carroll were dishing on all things volatility trading, from what March looked like down in the trenches to what worries them most moving forward, to what alternative risk premium strategies we're able to do or not do in the recent crisis. Joining us to talk about it all is Jim Carroll, Vice President at Toroso Advisors, and better known to our listeners perhaps as Vixologist on Twitter. Welcome, Jim.
Hey, Jeff, how are you?
Good, thanks. And we've got RCM Alternatives Head of Research, John Cummings, who's been analyzing vol trading strategies and managers for years. So welcome to you, John.
Thanks, Jeff. Good to meet you, Jim. First time, I believe.
Thanks.
So, yeah, both of you virtually attended the conference with me. So let's just get into it. Three of us just want to talk through some opinions we agreed with, thoughts that made us scratch our heads, things that made us go, to quote, crash test dummies. So anyway, on to the, so I think for myself, the two money panels were A, the Benn Eifert panel and Jim Carroll, and B, the Bhansali panel, where I think the bulk of the vol trading and portfolio construction pieces we're talking about. So I think we're likely to spend most of our time on those. So I want to push those aside for a second and just kind of say what were, besides those two panels, what else caught your attention? John, what stuck out to you?
I didn't have much. I thought it was very interesting, but no, for me, the risk premium, the last session I thought was interesting just because it reminded me so much of our discussions that you and I, Jeff, and our investors have had over managed futures over the last 5, 7, 10 years. The complaints that those guys are having right now, is to trade beta, underperforming the S&P, not really performing when they're supposed to, all kind of things, challenges that, we've been dealing with now for a while on the managed future side of the business. And, after I got off that conference, I was doing a little Googling on risk premium, and one of the comments, I think it was an institutional investor magazine, was risk premium is just managed futures with better marketing. So maybe that's why it made a lot of sense.
At some point there was like managed futures is just X with better marketing. That was us in 2009. Yeah. I couldn't understand from some of those panels whether they were saying the risk premia strategies are underperforming the premia, the base, or they're just underperforming overall and people expected them to have gone up. Or it wasn't clear for me whether they're saying, the whole premia is not performing, or whether their distinct strategies are underperforming the premia they're trying to capture, or perhaps both. Did you guys catch either side of that?
Maybe both. I mean, it seems like they're underperforming the risk-free rate. So I guess that would be the exchange, right? You're giving up the risk-free for some type of risk premia. My understanding, I could be wrong there, but looking at like AQR's mutual fund, I think they're allocated like 55% or something to long equities of some sort. So, when the market crashes like it did in March, wouldn't necessarily expect those strategies to be uncorrelated or lowly correlated to stocks. You expect pretty much what happened.
Yeah, and I snuck the question in there on one of the panels of like, hold on, are you saying risk premia wasn't designed and won't perform in a large volatility spike? Because they were kind of making some excuses of, the market moves so fast, so quickly, the risk premia strategy, their models aren't designed to kind of handle those types of dislocations. And I feel from the investor standpoint, they're like, what are you talking about? They're marketed as alternative investments and, things you would look to handle that kind of thing.
Right.
Jim, what do you think?
Well, there are a couple of sort of recurring themes that go beyond the EQD conference, but I think are worth commenting on. One is I think you have a lot of relatively large pools of money, pensions, endowments, a whole host of folk who are perhaps dipping their toes or started dipping their toes 5-7 years ago into areas that maybe they hadn't been in before, looking for, less correlated, uncorrelated, alternative sources of alpha. And as we've seen, particularly this year, sometimes that leads you down the wrong path. And you wake up and find out you've got a giant hole blown into your portfolio.
Right.
By some
selling variance swaps or something for yield.
Yeah. Right. And I think it's writ large in part because fixed income allocations aren't doing what they traditionally have done. They're not providing income, that's for sure. And they're not providing the negative correlation to moves in equities that sometimes people are used to seeing. Just recently we've seen treasuries selling off with equities. That's unfair. That's not what we're used to. But I think where people have used bonds as a source of risk management historically, the 60-40 portfolio, bonds are not managing risk the way they used to, and it's causing people to look other places. And when they start looking other places, they're not necessarily, they're catching up on the necessary homework to put money into some of these quote unquote alternative strategies.
Yeah.
So I think what they're getting maybe is not what's been advertised and certainly not what they were expecting.
To me, I always think of alternative risk premia as like the salad bar, right? Or the buffet, and you can go right. Sometimes I just want to order the Caesar salad and I get it served up to me nicely and it's all prepared. But the risk premia, you can go pick whichever pieces you want, put in your own salad. Then you get back to the table and you're like, this doesn't taste like I wanted it to taste. So a lot of it to me is the own investor's fault of like, you're the ones, you kind of demanded it got broken out into these individual sleeves. You're the ones accessing the individual sleeves. If it doesn't work out, it's kind of on you. It's not necessarily on the people devising the sleeves. Although on the flip side, if they're saying they underperform the actual premia, and the panels, John read, I don't think they got into that as much of like, there's some research out there that the more money that goes into a risk premia, the less that risk premia exists. I don't think they got into that as much.
No, they didn't. But they did mention. I think they did say crowded trading as a passing comment.
Yeah, if
I don't know how much they could really get into it without worry about injuring their business.
That's true. But I think that the classic one there is liquidity or illiquidity risk premium. So if you make that all of a sudden into a liquid product, are you necessarily taking away from that premium? And then part of the end of that panel I was interested in, they were talking about commodities. Can commodities be an inflation hedge? What are your thoughts on that, John? You were tying that back to trend as well, or managed futures?
Yeah, I thought that there's I don't know. We haven't seen an very inflationary environment in a long time. So it's hard to say. This is the classic when people are looking at managed futures, like, well, I want long commodity, and it's I'm sure we'll talk about it. Chris Cole's white paper, having this long commodity piece. Doesn't really perform over the long haul, obviously. And then, having long commodity trend by itself, we don't see many CTAs doing that because it just looks so bad on paper. I think there's like 2, maybe 3 groups out there I'm aware of. So I'm skeptical, but, it would make sense in theory.
Well, hasn't it been a case, not unlike the sort of long vol allocation that has just been a bleeder, since 2008, when everybody decided they needed to have a long vol allocation after, they were clubbed by the 2008 crisis. It seems to me that a lot of the CTA world has suffered from, that same bias. Everybody wants to jump in right after the performance has been great, and doesn't recognize that there may be meaningful periods of time where the performance is okay, but you'd rather be in the S&P 500.
Right. And I think in the panel more they were saying right, I'm in this carry risk premium, or I'm in all these things that kind of have this, in a crisis, correlations go to 1, and have that correlation where their investors are coming back to them like, hey, I didn't know this trade had so much beta in it. Which again, I'm like, well, be careful grabbing the beets off the salad bar then. That's on you. All right, so talk to those guys. I'll mention one other thing that caught my attention before we go into those good panels was the right off the bat, the Eurex was talking about how they survived March. And they mentioned the stat that margin went from 60 billion to 120 billion overnight, which was eye-opening to me. And I don't think maybe the people at this conference get it, but I don't think the investing world as a whole gets it, that these derivatives markets are functioning with high level of efficiency, safety, counterparty risk has been nearly removed. So right when we think back 20, 30 years to a crisis, there was a lot of body bags, people getting taken out. And nowadays it seems like it gets handled relatively orderly. All right, let's get into the good stuff and talk about the first real panel. To me was this learning 2020's lessons, portfolio design, and tail risk management. So it had Benn Eifert of QVR, Jim Carroll of Aegea, and Roxton McNeil of UPS Investment Trust. So this panel to me was just great. You had Ben and Jem trading nuggets of wisdom, and then Roxton just sort of comes over the top and says, hey, I do this with billions of dollars. And, basically in-house. So it was all pretty darn good. John, what were your kind of main takeaways from those 3 guys?
Roxton doesn't like to pay fees. He pretty much came out and said that, I can do all this what you guys are doing. I don't pay fees. I think for all these guys, I think the most interesting thing now, and I think what to be seen, from Chen, I'm not gonna pronounce his name right. Shem, right? How do you pronounce it? Jem. Sorry, Jem. If you listen to this, he's basically talking about looking right now, you say the banks are hedged now, right? And so it seems like the common theme with these guys is you needed a big vol compression to come back down, and then get everyone feeling like safe and sound, see some volatility, option writing types of scenarios. But now, post March, and people are talking about the potential for a second leg down type of move. And from this panel, to me, it seemed like they're not so much worried about that. They feel like everyone's hedged out, and that in the unlikely event of a surprise victory tomorrow, or second wave of COVID, it doesn't seem like the second wave, at least in my opinion, it doesn't seem like the second wave down concerns these gentlemen as much as maybe potentially some other investors that are out there.
Jim, what do you think?
Yeah, I think that was my takeaway in general as well. I think I was sort of blown away by Ruxton's piece of the presentation.
Yeah,
I'm not, the UPS pension trust. You're thinking about guys running around in brown trucks and brown uniforms, and this guy comes out just blazing.
Yeah.
I was not. I think I might have heard his name once before, but very clearly he is. Well, you guys probably have a better perspective than I do on the talent across the pension frontier, but he struck me as somebody who knew his stuff in great depth and was implementing strategies at a level that is probably unusual.
Yeah, I wrote in my notes here that he basically gave a master's degree in tail risk hedging strategies in about 5 minutes, rifling through all the ways he sees it. And we can just
do it all in-house.
Yeah. So we can just start with some of the things he said, because I thought they were great. He said you need a diversified set of hedges to be effective. And he said hedge across any tool that's available to you. So he's kind of saying he has some things that are available to him that aren't available to the rest of us, but that could include fixed income, strips, vanilla options, over-the-counter stuff. And then what was interesting to me, he was kind of saying they target dollar values of Vega, Gamma. I can't remember which other Greeks he used, but basically they're constructing the hedge to do those. They're crazy about addressing the cost in each of those risk budgets, funding legs with carry trades, selling vol, and intraday hedge. What else was he saying? And then he said they're always, looking to reduce the path dependency, so adding as many pieces as possible.
Yeah, it just sounded incredibly complex to me. One of my Twitter buddies sits inside of a much larger state organization, and he was just blown away. He said, I understand what this guy's doing, and I also can tell you that we wouldn't ever get close to the level of sort of use, diversification, detail, and probably in large part because the guys upstairs just simply don't understand it.
Yeah, right. Well, that's the thing. Like, he's not only brilliant on being able to structure the tail hedge, but he must have a second PhD in being able to sell it to the investment board, right? That's almost the harder piece.
Well, I would hazard a guess that, he's established a track record and demonstrated that he knows what he's doing, and therefore probably has, a fairly long leash to get stuff done. I doubt that he's having to get stuff approved on a day-to-day basis.
No, but overall,
Yeah, I'm sure he's, because he did talk about budgets, both in terms of, how they're managing risk and how they're managing the cost of the hedging program. So I'm sure he's established parameters, and within those parameters, he's probably got free reign to get stuff done.
And so coming back, John, you were saying both Jem and Ben were kind of saying coming into March, the spring was compressed. everyone had been trying to sell skew, sell vol to generate yield, and now that's kind of disappeared. What did they say about, are those natural sellers still out there?
Yeah, I think they're slowly maybe coming back is I think what I took away from it, but definitely not at the level where they were. So it sounds like to me you kind of need like this constant, I'd say, I don't know what word I'm looking for, but basically a cycle. That's what I'm saying. Like kind of a cycle where, you know, you have lots of low volatility, lots of option writing in the market. That's like, you know, then you have some fall type event, which then resets everything. Banks hedge themselves. And then we kind of maybe go through this choppy period for a while until investors get complacent again, and then, you know, begin to load up more on the short vol strategies, which then, you know, cycles back into another potential, you know, volatility event, which seems to be, based on the next panel's comments, like a 3 to 5 year time horizon is what they kind of look at. But, you know, what in terms of the institutional side of it, you know, I think Jem's good point though was a lot of these institutions are looking at this over the last 20 years of market history. That's, you know, they're trying to catch up maybe to Rocks and then maybe some of the other guys out there, you know, been volatility specialists the whole career trying to catch up and get to that level. But I think Jem's point was like, they're already so far behind the curve. And then two, the recent data points they had to work with over the last 20 years, are those even relevant for the next volatility event?
Right. And he was, and Ben was kind of on the institutional flows. That's all looking like call overrights, secured puts, you know, things that have viewed as a diversifier, but institutions kind of taken a step back from that. And then I had in my notes that Ben did say there has been a surge in option demand, both for hedging and equity replacement, basically no decent Jan here. Kind of for the reasons you said of the election, second wave of the pandemic. And he was saying until now, there have been no real new option demand, you know, just kind of option selling. And then they also got into a bit of the retail flow, the FANG stocks and whatnot.
Right.
So that leads into, they also talked about, was it, because it sounds from what you're saying, like, hey, it's too late for tail hedge protection. But they were asked that, what do you guys remember from that discussion?
Well, I think they weren't. My recollection is that they weren't shutting it down completely. You know, there's been sort of a Twitter debate going on about whether everybody's all hedged up going into this thing, or whether there is room for, you know, kind of a further surge to the upside in implied vol. And, you know, even in the last couple of months, you know, whether it's the June, we had the little burst in June, the end of August, first week of September, and then just this last 10 days or so, you know, we've seen these little mini surges where two things have happened. Vol has kind of compressed just in a range. And at the same time, you know, like I remember pointing out to people on Twitter at the end of August, we've got this giant spread between implieds and realized. And, you know, it's just way wider than it normally is. And so everybody says, well, yeah, because implieds are coming down. They're going to follow realized down. Okay, well, what if it happens the other way?
Right, right. Realizes come up.
Yeah, and that's, you know, that is what happened at the end of August into the first week of September, and less so, you know, in the last week. So, you know, I think people are looking at some of these historical relationships and the level of implied volatility and saying implied vol is just too high. Implied vol is too high. It's got to come in. It's got to come in. But it's gotten very stubborn. One of the things, you know, very kind of naive analysis, if you just take the VIX index and you look back, you know, to when it started and you say, where's the 1 year moving average of the VIX index? When that 1 year moving average gets above 20, it small sample set, but yeah, you know, it tends to stay there for a little while. And guess what? We went back above 20 this year, and we've been above 20 for, well, I forget how many days now, but, basically since, the end of February, VIX has been above 20. And so just because VIX is above average doesn't mean it's going to crash back down to the teens.
Right. I think that Benn Eifert had a line there that higher vol isn't always more expensive vol.
Exactly.
Sometimes depends what the landscape looks like, and sometimes it's higher on purpose because it's higher.
Now, obviously, you'd rather, if you're going to take long vol, do you want to start with VIX at 12 or with VIX at 30? Well, gee, I guess I'd rather start with it at 12.
Right.
But,
yeah.
That doesn't mean you can't, make some money. It may just be a little trickier. You may have to be a little more nimble.
Yeah, and I think overall they were sort of saying, John, correct me if I'm wrong, but it felt like they're saying like, no, it's not too late. I think Eifert said you got to be a little more choosy. Things aren't as cheap. And then Jim had some stuff about the middle period and some charts. You remember that, John?
Yeah, he does have, he basically said had a chart. I believe it was like the best times, worst environments, best and worst to sell implied volatility, and kind of showed that out there. Don't remember exactly.
Which is interesting because he likes to look at the world through the lens of an at-the-money SPX straddle, which is not unlike the Logica guys, right?
Yeah.
They love to play the straddles, and it's I think it's a great way to look at levels of implied vol. And yeah, that chart was interesting. Clearly there is a point at which people have bid up implied vol to a level where it almost has to mean revert over some reasonable period of time. But does anybody really want to be the first one to sell? And so his chart said, hey, if you get high enough in your implied vol, you're going to get a return from selling straddles. And the worst place to sell straddles, was in that 20 to 28 level, which basically says that's where you can get caught offside.
Yeah, which you'd think, coming from 12, you'd think that's a great place to sell straddles. I was just at 12. Now I'm at twice as high in the vol, 24.
Right. Got to sell these things.
His research is showing that it can spike more from those middle levels, I think he was calling them.
Yeah, that's exactly right. And that's the problem is you're in these middle levels and you don't know whether you're on the way down or you're still on the way up.
Right. Or sideways.
Well, and sideways being the worst, arguably.
Yeah.
You don't make money either direction.
Well, sideways for vol, I meant, but yeah. Because sideways for the market would be down for vol, right?
Right. Yeah, but sideways for the straddle, whether you're a buyer or a seller, you're doing nothing.
And then I remembered our guy Roxton again. He said basically just as an allocator, he has no idea what's going to happen tomorrow, and he just wants the hedge on. So he wants this tail protection to be part of his diversified set of hedges, and it's going to be on there no matter what the VIX level is, no matter what the narrative is. He just wants it on.
Well, I would guess that he's got some dials where he's probably dialing that up or down. I mean, it sounds like he's very clearly an active manager of that hedge position. So I would suspect he's got a little dial that goes to 11.
Yeah. All right, moving on. I kind of finished this panel with the largest risks for 2021. John, you got notes on that?
The largest risk for 2021. Yeah, so I think Eifert was saying he was looking at antitrust risk. Obviously Amazon, other big tech companies, Google, Apple, I guess a great example, with what's going on there with, Apple pretty much getting paid to promote Google through its platform, through the phones as a search option, stuff like that. I think all those things are.
They pay him $10 billion a year now or something.
Yeah, basically
the default iPhone. Which Apple's not going to want to give that up anytime soon.
No, correct, right? That's real money, and I think it sounds like there is a lot of potential for that. I would agree. To go along with that, I don't think they really talked about it here, but I think you could also tie that to the social unrest factors that a lot of people have been talking about, where through COVID and probably a long time before COVID, they really got exacerbated during COVID. Is obviously there's a lot of people doing really, really well right now, and there's a lot of people who are not, and that's going to be, I think, from my perspective, a real huge issue, in the markets and society here, no matter what happens with the elections over the next couple of weeks.
Yeah, just my forgot my word I was trying to say, but my just from a few friends and people I've been talking to just the last 2 days in Chicago, they're like, they're boarding up this shop, they're doing this. Where are you going to go for after the election? Like, people are, I think, more worried about the potential for riots afterwards than the actual election result. But I think Ben also. Sorry, go ahead.
It's not clear, which outcome is going to foment
more
the biggest unrest.
Yeah,
because I could see it going either way.
Yeah, that's scary. And I think to Ben's thing on the monopoly breakup, he was saying there's kind of movement on both sides of the aisle there, right? So no matter who gets control of everything, he's thinking that could be an item. What else? Jim, which we've had on our pod discussing ad nauseum, he was going towards fiscal policy and thinks kind of the world's underestimating the move from monetary, the Fed cutting rates, to the effects of fiscal policy of sending people checks. But I think we've already seen that last 2 months of markets up, markets down, vols up, vols down, because either Pelosi got a deal done or didn't get a deal done. Which was
I think I think what's interesting there, and I think the point that Jim has made more than once, is we're starting to push on a string with monetary policy, and clearly the Fed is not looking to be more active than they already have been, and is trying to. They've done everything they can to encourage Congress to pick up the ball. And this is where the outcome, not only of the presidential piece, but the Senate races, is going to be a big factor in sort of setting the stage for what is likely to happen. Trump has been promising a big fiscal package. Please reelect me and I'll give you all the money you're asking for. Clearly, the Democrats have an agenda to push forward. And so do we have a divided setup? Do we have a president on one side and the Senate still on the other side? Do we, which creates potential roadblocks for fiscal policy? Do we continue? Do we have some mega spend that tosses a different kind of hand grenade into the picture, because somehow the Treasury's got to go out and finance that? And we've seen a backup in rates. I think part of the reason that we've seen Treasuries not behaving the way people expect them to is because people are looking down the road saying, holy crap, the Treasury's going to have to be issuing trillions and trillions of dollars of bonds. Why do we want to own these things?
Yeah. And if the better the less we got to pay, the lower the rate.
Exactly.
Sorry, what were you saying, John?
No, I was just going to add, Roxton, I think he's coming at this from a very advantageous angle. It looks like he says, I don't know. So I'm going to add protection against the left side of distribution, keep my costs low, have risk budgets, Gamma Vega, those types of things, like all the stuff where he's a little advantage over the rest of us, where he's not necessarily reporting returns back to investors every month, at least not publicly. So, yeah, it seems like he has the biggest sandbox to play off with, like what we've been talking about. But I think that was kind of his ad was like, we don't know what it's going to be, so protect against everything.
Great. All right. Any other thoughts on those three, or we move on to the next money panel?
All good.
Move it on. So then this one had a better name, Vol Strategies in a Mad World. Like that. Couldn't have written it better myself. And so on this panel, you had Bhansali of Longtail Alpha, Chris Cole of Artemis Capital, and Vishnu Karela of Citadel. So I didn't know they let Citadel guys speak to the public. That's refreshing. Although you could tell he was for sure the most buttoned up of the three and a little guarded on what he'd be allowed to say. But what are your overall musings on those three?
I thought the piece that struck a chord with me was the notion of, okay, great. Let's say you catch a long vol position. How do you get out of it? Monetization.
Yeah.
And that was Veneer's big theme because he's written the paper on it. So he was.
And he's basically saying they wrote a somewhat simplistic for him piece, right. Academic piece on like, here's some simple models on how you could monetize long tail. And he said, that they've actually implemented some of those for their strategies. And voila, March serves up the perfect time to make sure you monetize earlier rather than later.
Right. Well, and I think everybody that I have talked to, met, who plays in the volatility space, long or short or both. There is a challenge, particularly on the long side, to positioning and exit, what Benn refers to as monetization, because in my view, if you catch lightning in a bottle, if you're there with a long position when the volcano erupts, I contend that nobody knows the two most important things: how far and how long. Is VIX going to go from 15 to 80 as it did in February, March? Nobody was really expecting that. And how long is it going to take? I think most people would say, wow, 15 to 80, that's going to take, I don't know, months.
Yeah.
Well, it took weeks. And so if you were riding that fucking Bronco, and all of a sudden you're in the money 2x, 3x, 4x, pick a number, what do you do?
Right. And just think of it, if you're long vol at 15 and it goes to 25, you're right, you just made 80%, but hey, it can go to 60. And from 60 it can go to 100.
And it did.
And then I also think of that if you'd bought like last November, right? Hey, we're a year out from this massive election. I'm going to buy some November puts or something a year out. Expensive, but I'm sure people were doing it. And then March happens. Now you've got those way out of the money. They're coming close to the money. They're doing whatever. And what do I do now? Right? Do I monetize it? Do I wait for my thesis was the election, but it's
right.
So I think that's the whole point of systematize that. So you're not having to have that mental arithmetic or mental gymnastics actually, and saying in the heat of the moment, what am I supposed to do?
Well, and I think that one of the challenges that really didn't get focused specifically in this panel was, systematic monetization. I think Veneer's point is systematic monetization is better than unsystematic, discretionary, hold on. The other piece of it that, unless it's just all your money, the other piece of it is, how does it play with your clients? What are their expectations? And when the dust settles, are they bitching at you because, you monetized 3x and you could have had 6x? My view has always been fire those clients.
Yeah.
Move on. But, that's the other piece to the whole monetization is, where does it fall in terms of backward-looking expectations, the angina that may be created because, you're perceived to have been, less efficient in monetization than you might have been, blah, blah, blah.
And I actually threw the question out there to the panel, like, well, is that become a self-fulfilling, prophecy? Is everyone monetizing sooner? And that's what's led to like the smaller pops and the quicker rebounds, which Chris Cole took that to the next level, saying, well, if everyone's hedged, is anyone hedged? Essentially, he got a little philosophical about that, but that's an interesting
what he's want to do.
Yeah. That's an interesting mental model of like, okay, if everyone's monetizing super quick, can you even get a big vol spike, or does it get sold into right away?
Well, I can tell you from, because I do traffic in a lot of vol traders, some of them reasonably sophisticated and some not so, but nevertheless, in aggregate, decent size. And, over the last 5 years, all of these little spikes have been little spikes for the most part.
Yeah.
Right. And so you've got, people out there saying, okay, I'm going to short it when it goes through the upper Bollinger Band. Right.
Right. That's worked 17 times in a row.
until February.
Yeah.
or until December of 2018. But, the buy the dip, it's basically the buy the dip in reverse, because rather than buying the dip in the S&P or the E-minis, you're shorting the spike in VIX, and most of the time that does work, and it builds up a mentality that level of, it's sort of the inverse of the monetization. If you happen to be long in that set of circumstances, you're looking at the same thing saying, "Ooh, this might be where I need to get out." And it's perfect timing most of the time. But then that one time where you bail out on February 28th because you're up 80%.
Yeah. Whoops.
Yeah.
I think
all of a sudden you don't want to tell anybody about your 80% win.
Yeah. Well, what's worse if it was 8% or something.
Well, yeah.
And then the investors that you're talking about on the other side, they might need to rebalance into their equities, or they have actual physical needs of that money, which I think we saw way back in 08, 09, John, with managed futures, of that became people's piggy bank. Right? They're like, hey, these things held up. These things made money. I'm going to cash out to refund my short vol trades.
Exactly. Well, and that's, and again, that can be a mismatch between what a strategist or a trader is trying to do and what their end investors are trying to do. Because if you're holding on to a position when your investors might want to rebalance, you've got a little mismatch in there.
Right. Or if you want to buy an NFL football team, it might be more likely to monetize
it. Right. As soon as you hit the magic number for who's he going to buy?
Right. The YOLO trade.
That was good, Johnny. Lost my train of thought. Then the other big word on that panel was the Aurora Boreas, right? Which they couldn't get enough of.
Which took Chris Cole all 30 seconds to say that word in that panel. He was chomping at the bit to say Aurora Boreas.
Which, you want to explain what it is, John?
I probably do a very bad job, but I'll try. It's basically this concept that the Ouroboros is a snake that eats itself, right? And he's applying that context to the financial system, and basically saying that yeah, I'm gonna lose my train of thought here now too. But it's saying like all these things that the Fed's doing, and various ways to impact how they impact the market and various traders, is that there's a cycle, and that it has a snake eating itself. And I think that's what they started to talk to about later, is that has it already happened, the snake eating itself and stuff like that.
Right. With basically Volmageddon was the first shot fired across the bow, right? Of like, this whole system's designed to suppress volatility, snake eating its own tail to the point where it's been suppressed so much that that's where I start to get confused myself. But does it get suppressed so much that the snake starts to eat its own tail? Or is the fact that you're suppressing it is the snake eating its own tail? One way or the other, it's the whole concept is it's a vicious cycle that creates more fragility in the end, right?
We need phone a friend.
Yeah, phone a friend.
Get Chris on the line.
Which
Right.
And he's convinced, and it's hard to argue with the fact set that he puts forth, that we just haven't seen the end of the debt cycle that we've embarked on. And whether it's the government debt cycle, whether it's the corporate debt cycle, certainly we're seeing what would appear to be a deterioration in the broad corporate credit environment, compounded by the likely impact of the COVID epidemic. Forget whether it gets worse again. The number of businesses that have gone kaput, the number of mortgages that are in forbearance, the number of leases that are in forbearance, the number of buildings that are empty, that have a lot of debt piled on top of them. He's convinced that all of that stuff is going to well up and cause much bigger problems.
Yeah, and he kept coming back to it's a solvency issue, right? He was saying the Fed's fixed the liquidity issue, but they've not come anywhere near touching the solvency issue. My thought on that came back to that FANG concept, and those bigger guys getting bigger and bigger, is they don't have any solvency issues. And maybe that's behind the scenes of what's driving their massive increase of, right? You're going to you take away that issue if you just buy those big names. And then I also remember
all of those guys are in many ways benefiting from the impact of COVID on the workplace. Microsoft certainly hasn't been hurt from a business perspective. They've got products, they've got a cloud. Amazon's got a cloud. Amazon's got delivery. We're all using. I'm using my iPad for the Zoom right here, and
Zoom's worth more than Exxon. And
exactly. So those trades seem secure, but there are huge swaths of the economy that are indebted, and in many respects, or in many cases, impaired in terms of their business models. And the question really is, I think he's right on that, that the Fed can deal with liquidity, but does the governmental enterprise, whether it's fiscal, monetary, or otherwise, are they prepared to backstop solvency?
Yeah, unknown. And then, sorry, go ahead, John.
No, which I was going to throw out, one of the other managers we work with wasn't part of this conference, but his comment today, Matt Laviolette from Breakout Funds, he put out a quick note saying, hey, we're all concentrated on the presidential election. And he was like, but I believe the real story this week is the Fed meeting. And what they say on Thursday is going to have a bigger impact on the markets for, this election here. So food for thought there as well.
And then Vishnu on this panel had said, there's still a two-way trade here. We kind of can get lulled into sleep of the Fed put, and they're not going to let the market go down. He was kind of arguing there's still two-way risks with the second wave, with these bankruptcies, with real estate. And he was kind of bringing that back into rate and gold vol. I mean, and that was the other part of this panel, right? Of like, hey, we're at this point, we've got so much debt, we either come out of it with a default or with inflation, both of which seemed like it would cause massive volatility, right? And especially in rates and especially in gold. Maybe less so if it's inflation and they're just suppressing S&P vol, it might push it out of S&P and into those other instruments.
Yeah, and I can't remember which panel it was. It might have been this one or probably maybe the one previously with Jim and Ben, but they were talking about currency vol as well.
Yeah, I think it was
which
this
would make
one.
sense with the rates.
Yeah, I think it was Veneer saying, when the currencies go, that can explode a economy. I think in hyperinflation and whatnot. And then it was also this panel that Veneer called it the GVC, the global virus crisis. I was like, what? Is that what we're calling this? I'm not a big fan of that name. I want to go with either COVID crisis or Corona crash. I like Corona crash the best.
You're the marketing guy. You tell us.
Yeah. All right. Any other thoughts on this panel?
No, I know Chris pretty well. I think he put out this white paper basically on this whole concept of Ouroboros and the serpent and the hawk and all that stuff. And in January, I think you and I, Jeff, are down in Miami and meeting with Chris and doing podcasts and attending a conference. And literally, did I expect to be talking about this whole thing in November? But he's hit a point with a lot of investors for sure. I've both big and small. I mean, I can't remember any time in my career where I've had so many just like high net worth individuals, a lot of people consider more retail investors, calling me about a white paper written by Chris Cole, who they probably never heard of before. But it's really, I think, kind of struck a chord with all these people in terms of it does make a lot of sense in terms of like, okay, you want to have these, but really at the end of the day, what he's saying is you want to have diversification, right? And I think, after this period of run up in stocks, a lot of people are looking at their portfolios and like, not really that diversified. So, being long gold, having commodity trend exposure in there, fixed income, obviously 1 point stocks, long volatility, which we really haven't, talked about, but he's a long vol guy. And then he also mentioned having some global macro in there, but he wasn't able to model that. So all stuff that you and I talk about every day, Jeff, with investors. So I just thought it was interesting that it's kind of all come full circle for me personally, reading this paper in January and now still talking about it today.
Right. I think his paper was looking across dozens of years, 100 years, right? Of like, hey, you need to protect against these potential hyperinflationary periods, these potential inflation, deflation. And yeah, here we are at this inflection point of basically it could go any of those ways relatively soon. Right. And I'd argue those individual investors are maybe more in tune to that than institutional, because they're seeing actual businesses they know go out of business, and right, they're more on that perhaps Main Street level of like, this is really happening here.
Yeah. There were two other things that I thought were important, if I may.
Yeah, you may.
One was, this was some Chris Cole commentary, but I think it's, echoed by the other participants on both panels, just the magnitude of option flows currently versus pick a number, 5 years ago, 10 years ago.
Yeah.
And both, institutional and retail. Obviously, the Robinhood stuff has gotten a lot of publicity this year, but the thing that brought home to me is options are inherently a source of leverage, and that's good when it works.
Good.
Right, but it's essentially increasing leverage in the system. And that cuts both ways, right? And so we see these reactions in the market, these V-shaped recoveries and these precipitous drops. We're used to people saying you take the escalator up and the elevator down. well, we're now seeing, elevators going in both directions.
Yeah.
And I think a decent chunk of that is the implicit leverage that we've, added to the system over time. And, related to that, when they were talking about what happened in March, I think there were three things that happened in March, right? Everybody says, oh, well, the Fed came to the rescue. And yes, okay, that's true. The Fed had been doing stuff since the first week of March, but they, came out with their massive artillery, on the 23rd or so. But, and Jim has made this point a couple of times, there were a couple of other things the week prior. March 18th was the expiration of the VIX futures contract. So we had a VIX expiration, and we also had an options expiration, a big options expiration on, I think it was the 20th.
23rd.
Yeah. And given the flows, just again, the derivative flows and the positioning of dealers, going into and coming out of those things are having outsized impacts versus, what we would have seen, again, 5, 10, 15 years ago. And so keeping those dates in mind, when you're in a free fall,
yeah,
or when you're, rocking and rolling the other direction, I think the average investor has no clue when
right.
those events are coming up, and what the potential impact might be.
It's a natural point where some of that leverage is taken out of the system.
Right.
Yeah. My argument to that would be it's non-recourse leverage. I guess if you're buying the options, right, which makes it a little less scary than margin leverage or something.
Sure, absolutely.
But yeah, at the same point, that's a good point I hadn't heard before. Like all this option activity is essentially just leverage activity.
Well, and I think it's amplifying some of these moves.
Yeah.
Particularly as obviously you've got a whole bunch of people out there dealing the other side of people's desire to buy and sell options, and trying to run books that don't blow up. And obviously we saw some blowups in March in the derivatives community, but those folks were doing things that perhaps they look back and say, gee, why were we doing that?
They were doing your VIX trade on the Bollinger Band.
in institutional size.
Yeah, big size. And you said you had two? What was your second one?
No, it was number one was just the sort of magnitude of the derivatives, and then the other one was sort of the date specific impact that some of those derivative flows can have on, maybe causing things to find a bottom, when the selling starts to dry up.
Right.
No, the point was a simple one, which was that everybody looks at the headline that the Fed came to the rescue, and clearly that was part of it, but there were some other things going on sort of under the surface.
Right. All right, guys, I think that's it. Any other last thoughts?
No, but I got it. This is for Allie.
Nice. And our YouTube.
There you go.
I was going to ask.
Hey, I got to do your job for you,
Right.
Mm-hmm.
I was going to ask everyone's favorite, who they want to hear more from, but I think the answer was Roxton.
He was a rock star in my book.
Yeah. So we'll try and get him on the pod next.
That would be a good move, I think.
In the future. All right. Thanks, guys. We'll talk to you soon.
All right.
All right.
Good to see you, John. Thanks, Jeff.
From this episode will be in the episode description of this channel. Follow us on Twitter at RCM Alt and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you.